Options can be confusing for beginners, but at the end of this super simple video, you will have a very clear idea how it works. You are watching episode 1 of my Start from Zero course. Let's start with this expensive scoop of ice cream that cost $20. And to enjoy this little treat, you also need to pay separately for the cone an additional $130. That may sound ridiculous, but you do need something to hold it so you can have it. That must be one hell of an ice cream, but let's swap the cone and the cream with stock and profits. If you want to enjoy the profits, you first need to buy and hold the stock. Let's take this Apple stock for example, which is currently trading at $130 per share. Assume they have a new product launching soon, and this can go up to $150. The potential upside here is $20, and to get there, you have to buy the stock at $130. This sounds like any other stock trade, but the problem with stock is, irrespective of whether you are going to keep this for 20 minutes or 20 years, you still have to pay the same $130 to enter into the trade. And we have been doing this for so long, we don't find it very odd that we pay the same price irrespective of duration. And this is where the options market can make a difference. Options give us an alternative way to do the same trade in a much more cheaper fashion. You can make the same $20 profit by replacing the stock with an option that costs just $1. So basically, options can capture all the upside without owning the stock for a small convenience fee. Let's go to the trading platform and see how to buy an option. I'm doing this on the Robinhood platform, and yours might look slightly different. Let's pull up Apple and say trade options. The first thing we see here is a table with a bunch of random numbers. This is called an options chain, and it is where you spend the most time as an options trader making your trading decisions. At first, this might seem like a lot of information, but this gives you the ability to customize so that you can achieve maximum profit with the lowest capital. The first thing you need to do when making a trade is to choose the option type, which is a call or a put. There's only two kinds of them in the whole universe. And for this example, we're going to trade a call option. And once you decide on the option type, you then decide to buy or sell the option. We will talk about selling and puts later. For now, the default option is buying a call, and that is what we need for this example. The next thing we have to do is to choose an expiration date. Because options let you customize, you can pick a date that is close to when the stock is going to hit your target. So in our example, the product launch is happening this week, so I'm going to choose the one that's closest. And the next part is to select something called a strike price. A strike price is basically where your trade starts to make a profit. So if I buy the 130 call option, I can capture all the upside above 130. So if the stock goes to $150, my 130 call option will be worth $20. So a 130 call option would have the same profit potential as buying a stock at 130. Both of these trades will make money as the stock goes up, but the call option will expire in 2 days. Similarly, if I buy the 140 call option, this will start making profit as the stock goes above 140. So a 140 call option would have the same profit potential as buying the stock at 140. Right now, this is very cheap at 3 cents because there's only 2 days left for the expiration and the company is not launching any products. So most likely the stock won't go to this level and will be priced much lower. Options get more and more expensive as you go further out. So if you look at the prices for next month, the 130 call option is worth $5 and the 140 is worth $158. So if you think Apple might go up to $150 in the next 1 month, then you can buy either this or this one to capture the upside. Let's cancel these and try to buy the one for the 19th. When I try to place an order, you might notice that it'll ask me for 155. This is because options are always dealt in multiples of 100. So let's go ahead and multiply everything by 100 in our previous example. So instead of one stock, options let you control the price moves and capture the upside of 100 stocks. So if we bought 100 shares of Apple, it would have been worth $13,000. that would give a profit of 2000, but options let you capture the same profit with just 155. And because of this reason, options can be extremely powerful. Now that we got a brief idea on a call option, let me show you a real trade from Reddit. So I saw this post last week and it was very cool. I was very happy for him. He goes, "My first ever option trade. Did I get lucky?" So basically what he did was he bought a call option for just $12, and few days later it was worth 150. He was just trying to learn. He just bought a call option and it went up like 1000%. So let's compare this example with what we just learned. This was a $30 call option, which means that it starts making money when the stock goes above 30, and it looks like it went to 31.50. So it basically went $1.50 above the strike price, and that's why it's worth 150. So the math makes sense. So normally cheap options to go up 10 times like this is kind of rare. So let's see what BHC did in that 1 week. Okay, let's pull up BHC. This is Bauch Health, and right now it's 31.90. And if I do see the 1 week trend and the 1 month trend, it does have a steep jump around the 12th of February, which is when the options expired. So basically the week before the expiration, the stock was trading at just 24 and it had a massive run up, finishing on 31.50. So that shows why this $12 call option made such a big return. So if the stock did not go as big, probably the option would have lost its value and expired as 0. Even though it looks easy, most of the call options expire as 0. For example, here is something I bought last week for 70. I bought 2 of them and today it's expiring as 0. The strike price was $5, but the stock crashed and finished at $1, making the calls expired worthless. And for this reason, options can be risky and dangerous. As you keep buying more and more call options and they expire as 0, you would have nothing left at the end. So it is very important to follow certain practices such as position sizing and make sure you don't lose money that you cannot afford to lose. So if I have a $10,000 account, at the max I would risk about maybe 100 or 200 per trade. This way, even if it goes to 0, I only lose 1% of my account. So a strong understanding of how options work combined with the right discipline is what can make you a successful options trader. What you're looking at here is a list of topics that I believe every trader should have knowledge on, and that is what I hope to cover in my course. Today we quickly looked at a few things like strike price, expiration, and there is so much more that I'm going to cover in the future videos. The actual meaning of a call option is to buy or sell 100 shares of the stock. And that is what I'm going to cover in my next episode using an example from the airline industry called as price locks. And do check out the full playlist of this course in the description down below. If you like this video, smash that like button and subscribe to my channel. And I'll catch you in the next one.